Good morning, everybody. I think we can get going. So this morning, I've got a little bit of news, and Richard's going to do a story as well. And then we're going to be talking to Stuart Gray, who's one of the managers of Moody's Towers Watson of Alliance Trust. So news first. Three things that we pulled out. One is the demise of FundsmithEmerging. And then there's two new IPOs announced this week. So I'm going to be looking at sustainable farmland, and then Richard's going to be talking about independent living REIT. So Fundsmith first. Terry Smith basically billed this as like slightly magnanimous. We're going to give you the money back because it's not worked. I mean, we highlighted really not quite long ago on this show that it really wasn't performing very well. The only thing that irks me slightly about this statement is that there's this kind of proprietorial, is that the right word, kind of attitude towards it. You have to remember these things, that managers don't own these funds. It's the boards that control these things on behalf of the shareholders. And so, although probably liquidating it is the right thing to do, it's sort of seemed wrong that it was down to sort of the manager to decide we're going to liquidate the fund. Is the way it's kind of worded there. But what actually happened is that Fundsmith, I think, said to the board, look, this isn't working, we're going to resign. And the board did talk to some of the larger shareholders. We don't know how many. They could, as we said there, go and look for a new manager, but they said they've decided to opt to liquidate the fund. The whole thing could be wrapped up quite quickly. So could go into liquidation by the end of November, and I'd imagine that because the fund's reasonably liquid, that you'd be getting cash back quite soon after that. Of course, this is now the third one to disappear from the global emerging market sector, and perhaps this seems to be, sort of slightly over the top now, because all of these things are being liquidated rather than trying to find new homes for the money. There's the sort of performance slide. I think we don't need to rehash that and how bad the discount was getting. And here it is in the context of the rest of the sector. Obviously, emerging markets have not been flavor of the month or year. In fact, some of them have been really quite poor. Ones that were exposed to Russia were hit particularly hard, and that obviously affected things like Baring's Emerging EMEA Opportunities, who we're actually going to be talking to next week. It's also part of the reason why Fidelity Emerging has done so badly. But just look at those long-term returns, that's really not very good. Fundsmith actually was an awful lot better than that. The only sort of real star of the show here are Utilico Emerging Markets, which has got quite an eclectic strategy, and Gulf Investment Fund, which we've written about today. I think they'll be in the QD today, which is doing particularly well because of obviously the high oil prices are boosting the economies in that region, that part of the world. So it's difficult in this kind of scenario to try and find a way of rolling over money. But independent Monk's combination proved, or just illustrated, because I've seen it before, just illustrated it is possible to roll over funds even if they're trading on a discount, especially if you're going from a fund trading a particularly wide discount to something a bit narrower. So this is now only 5.8, but it was a lot wider than that. It would have been possible to opt for one of these. And the one that we've been suggesting for a while is Mobius, which is a bit too small. This is a big chunk of cash to be leaving the sector, 350 million quid. The other two funds that left weren't that big. So I think it's a bit of a shame that they couldn't do something more imaginative with it. I suppose the hope would be that anybody who wants to stay invested in emerging markets just reinvest into one of the other ones. So we'll see what happens. That's just Fundsmith. Now, sustainable farmland. This is something really quite different. So they're looking for £200 million. The offer is open to retail investors who want to participate, which is good news because if you remember, the Welcome China private equity fund we talked about last week wasn't. It's a mostly US dollar based portfolio, almost entirely US dollar based portfolio, but the quote's going to be in sterling. You may think that's actually quite a nice position to be in at the moment. So sterling looks like it might be quite weak relative to the dollar for some time yet. I have to wait and see whether that's true or not, but I think it's probably ticking the box for it. It's a decent-ish yield once it gets fully invested. I think the target is 2% for the first year, and then rising to about 4.5% when it's fully invested. And they're talking about total returns of 7 to 9%. The fees, I like the fee structure. It's only charged on the cash that they've invested. There's no sort of payment for them to sit on the cash while they're looking for things to invest in. And there's no performance fee, which is also probably a good tick in the box. The manager's been around for a long time, in slight contrast to some of the other funds that are trying to launch in this area. And they've got quite a big team and a decent size of assets under management, $2.2 billion. There's an existing unlisted Evergreen Fund. So it's not a normal limited partnership structure that lasts about 10 years. This is an Evergreen Fund that's already got 31,000 acres of land spread across, I think, 7 states in the US, growing about 20 different crops. The things that it's done to try and differentiate it from peers, there's quite a sort of jargon that they've invented. One of them is this thing called top growers. So they've got this idea that they've selected farmers who are bigger than average, younger than average, more technology minded. So they're willing to work with them on things like trying to improve soil health and using the right strains of seeds and things to get the best crop yields. They've also got quite good relations with some of the big customers, so people like Kellogg's and Coca-Cola and Pepsi and all those sort of people. So they're often growing crops to order for them. So that means you've got sort of guaranteed take up for the crop that's produced, and that helps in terms of the rents that they can charge. And they are putting quite a lot of technology, data science behind trying to improve the yields on the portfolio. So trying to basically make sure the right crop's going in the right place. And to some extent, it's not just a rental income. To some extent, they also got exposure to the crop profitability as well. So depending what the crop yield is and what price that fetches. And so that sort of makes it slightly less predictable income, but it doesn't like supercharging what would have been there otherwise. They're splitting the portfolio in two, 60-40 between the core, which is the existing fund, the one with 31,000 acres, and what they call Core Plus, which is going to be invested directly into farmland. Some of that might be outside the US. They mentioned Australia as a possibility. They may also invest in agricultural infrastructure, so things like cold storage, grain storage, water management facilities, that sort of thing. And so again, the revenue mix of the Core Plus strategy is a bit different and a bit less predictable maybe than the core area. But they reckon they can earn higher returns on that bit. But to get to the target returns that they're talking about at the beginning, they need to use leverage. And I suppose this, to me, might be the sticking point for some people when they look at this fund. It's going to be really quite geared, so about kind of 45%. Against that, they're saying that the income is relatively predictable. Things like crop failures and stuff are insured against. There's quite good inflation linkage in terms of the income that they get. But it's just going to come down to whether investors are comfortable with that sort of level of gearing or not. We'll wait and see. In terms of the sustainable angle, in the new taxonomy, it's an Article 8 fund, what they call light green. So the idea of Article 8 funds is that they are improving ESG kind of aspects, but that's not their kind of central mission. They do say, in terms of what sustainable farmers are trying to achieve, they want to leave the land better than they found it. And that's really around soil health. That's the main thing. But they also look at things like water management, trying not to use too much water and minimize the use of fertilizers. But what it isn't is organic farming. It's not going to that extreme. So I do think it's an interesting fund. But as I say, others have tried and failed. So we'll just have to wait and see whether that one gets away or not. Now I'm going to hand over to Richard to talk about independent living REIT.
Great, thanks, James. Yeah, so another intention to float announcement this week. This from Independent Living REIT. So they're looking for 150 million. Again, it's open to retail investors, which is good. They're targeting a 5p dividend for the first 2 full financial years, and then we'll aim to grow that, and a 7 to 10% total return target. Management fee, like most of in the property sector, are based on NAV, and you can see that there, 0.95% on up to 500 million, and then 0.75 over that. So interesting time to be launching a company in this sector. Obviously, there's a couple already in this space, Civitas and Triple Point Social Housing. So the manager's Atrato, which is the manager of Supermarket Income REIT and Atrato On-Site Energy. And they assembled this social housing team in May, and they've spent the last 3 years creating a partnership model with housing associations, which they say addresses some of the concerns of the regulator, which has really sort of dogged this sector really in the last few years. So I'll come on to that later, but they say they look to address the shortage of supported housing, which there definitely is, and they're going to focus on 3 main sectors, which is specialised supported housing. This is sort of housing for adults with learning difficulties, mental health problems, things like that. Extra care, which is sort of alternative to care homes. They're sort of blocks of flats, 55-year-olds and above, and then homeless accommodation. And there's definite savings for taxpayers, as to house, for the government to house these people in need of these housing. It will cost a lot more through other means, and it's been proven that these specialist housing has better outcomes for the residents. So that's all good. If we go on to the next slide. So they're looking to raise 150. They've got a 500 million investment pipeline ready to go. It's going to be, as with the others, it's government-backed income through housing benefit, inflation linked, and they're saying this is uncapped inflation, which is different to the peers in the sector. And they talk about this new partnership model that they've got. So it's going to be shorter leases, between 5 and 10 years, whereas the others are a lot longer, 25 years, and that's what has been some of the problems in the sector with the regulator. So the concerns that the regulator has with the model that Civitas and Triple Point have is that they rent out these properties to housing associations on 25-year leases, and there's a mismatch there of the income that they get from housing benefit and the care providers that they put in for about 5 years. So that's where the mismatch has been. And a lot of the housing associations, the regulator has published a lot of notices on the housing associations being non-compliant in financial things because of this reason. So Civitas is trading on a 30% discount and Triple Point on a 24% discount because of that they've not been able to overcome these hurdles with the regulator as yet. So we go on to the next slide. So Civitas have been working through this for years now, trying to work with the housing associations to achieve compliance with the regulator. And they've recently come up with a new clause that they're looking to implement into all of their leases, in which they will allow the housing associations to temporarily stop paying their rent if if they're not getting the income in through housing benefit for whatever reason, things like that. And Civitas would then receive that in arrears, basically, but they'll also have step-in rights in those situations as well. And this week they announced that 2 of their housing association tenants have approved that, and so they will start rolling that out into those leases, and they're looking to roll it out across the board. I mean, the sector as a whole is the fundamentals are all there for demand side, supply side. Obviously, it's social wise, it's really good, and it would appear that these companies are getting around or getting the regulatory approval, which is the main thing. It's just going to be interesting to see how this one goes, and if it gets off the ground. There was one earlier this year that, last year, that tried to launch and failed. So yeah, it'd be interesting to see if this one gets going. It's definitely needed.
Yeah,
we'll have to wait and see.
I think the thing that we always hang on about, and doesn't seem to be reflected in the rating, is that these things have never actually lost any money in terms of they always are collecting the rents, even when housing associations are running into trouble. So
yeah, I mean, the need for this housing is there, and it's not going to go away. So that is the main thing.
Yeah. Okay. Well, we'll see. Thanks very much for that, Richard. Now we're going to go on and